Good morning, everybody. You've got Brad Rustin again. I'd like to welcome you to our ongoing In the Trenches series. I'm joined today by two of my colleagues, one who you've heard from previously, Craig Nazzaro, former in-house counsel who works as part of our core financial regulatory team. I also have the pleasure today of being joined by Mark Miller from our Nashville office. Mark has spent about 20 years in practicing banking law at various firms. He recently joined Nelson Mullins, and so we'd like to welcome him today. We got a great topic we're going to be covering that's particularly important as we start to think through what banking and financial services how that looks in the wake of the COVID-19 pandemic, what we expect in terms of changes, and a little bit about some of the different options that are available for financial institutions as you're considering digital transformation. So really what we're going to talk about today is where the market is first. Talk a little bit about how, as many experts have said, the COVID-19 crisis has accelerated the digital transformation of America by about 5 years. Some have said even more than that in terms of moving people to a more mobile and online-driven relationship with their providers of services, banking services being one of those key. Then we're going to talk a little bit about some of the BSA AML issues you run into. We'll talk about CRA and fair lending and some other compliance regimes. Most importantly, the second half, we're going to really dive down, talk about FinTech partnerships, how those are being structured, some of the risk rewards associated with it. Talk a little bit about the FinTech sandboxes that have been developed that various states are adopting with the support, in some cases, of state banking and credit union associations to really help them develop new and innovative financial services products. And then we'll close out talking a little bit about FinTech charters. It's something that keeps floating around. Probably 4 years ago when you saw the first advent when the OCC issued some preliminary guidance on a FinTech charter, you saw this huge interest in FinTech charters. Everyone thought this was going to be the new way you conducted financial technology. And as we've seen, there's only been a few entities that have gone so far as to actually apply for a banking charter who were traditionally FinTech companies. And in those cases so far, it was not some sort of special FinTech specific charter. Instead, they obtained a mainstream banking charter. Still to be determined what the net effect of that's going to be long term as we move forward. But we'll talk a little bit about that at the end of our presentation today and what we foresee in terms of how that shift is occurring. And whether or not that's going to be somewhat guided by some of the recent litigation involving the bank FinTech partnerships that we'll be covering earlier. Got a few quotes here that are fairly interesting, really just to drive home the point, which is, when we think about banking services have been around and remained largely unchanged for many years. Until you get into the 90s, 2000s, really into the 2010s, you really don't see this massive digitization of banking, but we've seen that shift and it continues to accelerate, and perhaps more so in the wake of the COVID-19 crisis. So with that, I'm going to turn it over to Mark to talk a little bit about how we're seeing these shifts occurring, what alternatives are out there in terms of how banks are adapting to a more technology-driven platform, and a little bit about where we see this going in the future. So with that, Mark, you want to kick us off here?
Yeah, thanks, Brad. And I think the point you made that the COVID-19 crisis is obviously accelerating change. I mean, just think about any other aspect of daily life. How people have adapted so quickly, whether it's delivery service versus going to a store or a restaurant, or telehealth visits instead of going to see a physician. Banking's no different. It's forcing people to change their behavior, which is just accelerating all these processes that have been gearing up, if you will, for the last number of years. But I think it is a transition to a digital marketplace and more mobile banking. I know myself personally, I joke the only time I go into a bank branch is when I go visit a client. I do all my personal banking, online, deposit capture on my phone, all that good stuff. And then certainly, my parents and probably yours don't do any of that, but now do. So I think you're just seeing that type of change. What you're also seeing is these competitors to the traditional banking model. You have several of them on the screen here, the PayPals and the Venmos of the world that so many people use to not only purchase online goods, but to settle a bar tab between a couple friends the next day type thing through Venmo. And certainly Apple Pay is another challenger that we're seeing, where folks are avoiding using their credit card to just go straight through their Apple account. So you're seeing it in the lending side of it. You're seeing on the payment side. And I think another area now is the deposit gathering, where, instead of the traditional, run a CD rate by posting on the, your bank board or a newspaper ad, folks are turning to online sources to get a higher deposit rate, and frankly don't care where their money is sitting, because they're not going into a bank branch to access it. Then on the kind of internal side, you're seeing more and more providers that are, instead of the bank itself trying to compete by developing its own software, et cetera, turning to the various, FinTech type companies that have built out, AI and other, developed software products to quickly analyze a loan application, to quickly make the credit decision, or at least get it further down the process. And that's, again, just a trend in speed that's going to continue, I think, very rapidly. And what it does, again, from the consumer side, people are just used to things happening so fast now. It's the way the banks are going to keep up. Go ahead and hit the next slide, Brad. So we talk about a shift in technology. So we have some quotes here, which I think are great. Jamie Dimon, who is probably the most influential individual in financial services, probably in the entire world. His view: mobile first, digital everything. And again, it's, how does the consumer want to be served? The consumer wants to be served in an easiest, fastest way, from their phone, from their computer. Then I think the back office of that is everything has to be digitalized. Quote from the chairman of BBVA, that it says our biggest competitors aren't banks, it's Amazon and Google. And just yesterday, Amazon unveiled its small business credit, lining up with Goldman Sachs. And again, marrying, technology and one of the bluest of bluest chip, white shoe firms in the financial world. And in fact, Amazon was going to sort of have a marketplace of lenders and ended up just going with Goldman. But the idea is to quickly marry their customer, not their consumer customer, but their retailers, that the businesses that put their goods on Amazon that need credit, and now they can go through Amazon to get a loan from Goldman. So again, just a completely different way of thinking about how financial products are being delivered. Hit the next slide, please. And this is just a great chart we have in here, a great image. This, I guess, was originally taken from Wells Fargo's page of how they define the different offerings they had. Well, you can barely see the offerings in here, from just basic credit and insurance, investing, retirement accounts, wealth management, various types of college savings and lending, home lending, just basic bank services that one bank could provide. And this chart, which is really impossible to read, shows how that bank service is being carved up by so many different service providers. And again, I think the modern consumer, the days of a one-stop shop are over. Now you can easily research who's providing who has the best rate, and the result is you have all these different companies, none of which are banks on here, that are providing bank services. And the part that I also found really interesting when I looked at this was how many of these companies I've seen on TV now advertising, which again is just, to me, somewhat mind-blowing, that you have these non-bank entities that are no longer so specialized. No, they're appealing to mass consumers to the point where they're now advertising on I guess the most expensive media to do that. But it just take a moment to digest this slide, because it really is amazing of just how the traditional bank product has been so carved up by all these different non-bank entities.
And I think too, Mark, we're seeing a lot more acceptance of this, which I think is really kind of telling, and perhaps we're seeing as the biggest shift in the last few months is, originally you had to be early adopter, you had to be someone who was slightly technology driven. But as you say, there's, many individuals across the spectrum, regardless of age, socioeconomic condition, who have access and who have probably interacted with some of these companies that are splitting up the financial services industry. And so, we've just seen, this question of, now it's very easy to shop, and when you go to look for a commercial loan for your small business, there's 15 different people who might be providing it. You're not going to your local branch, to the banker you have used for 10 or 20 years and speaking with him or her and saying, hey, I'd like to obtain a small business line of credit. Instead, you can go online. And in fact, there's so many now, you have folks like Lending Tree and Credit Karma who are, simply aggregators of dozens of lenders so that you can compare them across the board. So it's, certainly interesting shift we're seeing.
No, I think that's exactly right. And if you're a consumer, you're going online, whether it's to, try to obtain that product from your existing bank or somebody else. It's almost the same process, right? I mean, you're just sitting in front of your computer or on your phone, and whether you're, dealing with, we'll pick on Wells Fargo since they're sitting right here on the screen, various accounts at Wells Fargo or any of these other providers. It's almost the same user experience. People just want the best answer, the fastest answer, and the best rate. And there are providers that can do that, frankly, at this point more effectively. And that's where people are going to go that are ready to make the plunge. And I think, as you said, it's not early adopters anymore. It's everybody. And I think you can kind of, if you flip to the next slide, Brad, have a good chart that kind of shows where the shift is. And again, it's not anything too surprising. It does break down by age bracket. The younger you are, the more likely you are to be using digital banking, whether it's a traditional bank or another provider. But obviously those groups migrate across the screen, and what does that mean? That means as time goes on, more and more people will be solely doing their banking online. That's a trend that, again, it's clear as day from a generational standpoint that it's going to continue. It's not going to back off.
So, Mark, one thing I would like to add there is that as we're going through these slides and talking about the different segments that we're seeing as banks shift to a digital solution or a digital product offering, is that while it's being adopted en masse by the U.S. Banking population, you don't have to look at this, depending on your bank size or where you are within the space, as a switch that's either on and off for digital solutions. You can, just moving into online account originations or, remote deposit captures. You start slowly and build out your compliance and regulatory controls there. But as we're showing you these slides to illustrate that it's clear that it's moving in that direction. But I don't want anyone on the phone or any of our clients to think that it's a tsunami and you have to turn the digital switch on and jump in with both feet. There are ways to soundly scale up your controls and your operations to start to wade into these digital solutions and digital product offerings.
Yeah, it's interesting.
Well, I completely agree, Craig. I think the point is, though, you probably have to start thinking about it.
Yeah, and it's interesting, Craig. You and I were talking right before the pandemic hit, and I remember the timings we were presenting on pandemic planning for financial institutions. We were talking to a state banking association at one of their conventions, and we're having this discussion about: do you have mobile RDC? Do you have a good network of ATMs that you can rely upon? How are you planning to do non-face-to-face financial transactions? And there are a lot of financial institutions that, because of risk tolerance or because of the infrastructure costs, still largely work as a brick and mortar financial institution. And I think both you and Mark make great points, which is this isn't a light switch where suddenly you're a digital bank or you're a brick and mortar bank. Instead, there's kind of a progression, and granted, during today's presentation, we're going to go fairly deeply down the rabbit hole from everything from the introduction to online banking to, true FinTech integration into banks. But it's really not a yes or no question. It really is a continuum from one to the other.
Agreed, Brad. The next slide is me. I wanted to point out here that, when moving towards digital solutions and innovations within your control space, it presents both opportunities and challenges for you as an institution or as a FinTech in the BSA, AML, and KYC spaces. When you're moving the origination and servicing of your products, or you're moving inherently to a more anonymous mode of interaction, often your products are also becoming more sophisticated as you grow in that direction. And with that, it comes with the need for greater sophistication of controls around your BSA, AML programs, or at least a minimum a risk assessment to determine your baseline customer risk in the BSA, AML spaces. I wanted to highlight this joint statement on innovative efforts to combat money laundering and terrorist financing released by the Fed, the OCC, the FDIC on December 3rd, 2018. The whole point of this joint statement was to drive home the narrative that each agency recognizes that there's private sector innovation, including new ways to use existing tools or adopting new technologies. We're going to talk about AI later. And all these can help banks identify to report money laundering, terrorist financing, and all the illicit financial activity that is made combated by the BSA and AML regulations. But it also it just strengthens the effectiveness and the efficiencies of banks' programs. But also what they're saying here is don't stop what you're doing when you're innovating. Don't drop your controls that are working in the BSA and AML spaces for what you believe is a better alternative, or chase the shiny new toy before you actually don't go chasing at the shiny new product or shiny new solution before you deploy, test it, and then test it again before you switch over your controls. And what they're saying here is that they're looking for pilot programs. They're looking for you to grow and scale your programs, but at the same time work with them in a partnership. They want to see what your controls, what these new controls, or if you're moving to a more innovative solution, the BSA AML spaces, what that looks like and how it's actually strengthening the core processes of the bank before you switch over. Next slide.
Yeah, one thing too, Craig, before we go too far down, is one of the things we see when we're working with banks or credit unions or lenders on BSA AML is don't assume that because it's non-face-to-face, it's going to be less valid. In fact, data suggests the opposite. When we're doing non-face-to-face identity verification, oftentimes we can do better identity verification than the traditional walk into a financial institution, hand over what appears to be a government ID, and look to see if the photo on the card matches the human being sitting across the desk from you, which of course in the FinCEN guidance is the default way that you identify a customer for KYC purposes. We have the technology now that, done right, you can actually get a better sense of the identity of the individual in an electronic environment than you can in face-to-face because of the potential risks of fraud. But obviously, as Craig said, that assumes it's done right, it's done in a thoughtful way that deals with some of those risks. So I just wanted to run that in, because that's the response we get from a lot of bankers and credit union officers as we talk about these issues.
It's a great point, Brad. For example, we'll see clients that are starting to move to online account origination or move into remote deposit capture, and they're worried about not their existing BSA AML programs or policies speak to individuals walking into a branch, and how can they achieve these controls in a new digital channel. And a lot of the hurdle for some of the people that are starting to wade into these innovations is adopting their existing procedures to a digital space. As Brad's saying, it's not always a lesser standard. A lot of the times you're moving into a higher standard. And that's basically what this joint statement was saying, that we recognize as your regulators that there are solutions out there. There are opportunities to strengthen these programs, and don't be afraid to switch your procedures up or switch your program up to accommodate for these new developments. They want to see the space innovate. They want to see the space grow, but at the same time, they don't want you to just completely abandon what your original control was. They want to see it, scale with you, grow with you, and be introduced at a speed and a pace which is obtainable for the institution. This next slide is the OCC risk perspective. The OCC publishes their risk perspective twice a year. It summarizes where their focus is, where they believe that the greatest risk is emanating from. The last one that came out was December of 2019, but if you look back towards the spring of 2019, which is where we took these two excerpts from, they focused on risks associated with innovation within the financial products and services, as well as artificial intelligence. If you're looking at that first box there, they're saying key operational risks include cybersecurity threats, as well as innovation in the financial products and services, and increasing use of third parties to provide and support operations that are not effectively understood, implemented, and controlled. When you read that in conjunction with that second one, we're just saying that the OCC has cautioned that certain new technologies such as AI and machine learning may add complexity and limit transparency, increasing the potential for compliance risks. It's imperative that you demonstrate adequate review and examination and investigation of these decisions. What they're saying here is somewhat obvious, the advice that they're giving, but often overlooked with some of our banking clients, is that you should demonstrate an adequate review of any new technology that you're deploying. While these solutions may be more sophisticated and offer a better metric of control and compliance, you're going to have to showcase that internally you know how they work. Internally, you know that you have proper third-party oversight of these partners that are providing these solutions. What you don't want to do is, go down. A lot of times, if you don't involve regulatory and compliance early enough, you'll see business units start to think, hey, look, this seems way more efficient. This seems way more productive. We can probably get more loans through. We can probably get decisions quicker. And everything they're telling us is that it's more conservative. It's more adequate of control. And if regulatory and compliance isn't reviewing and vetting that, the regulator is going to look at it like you just adopted a control from somebody's sales pitch. You want to be able to show that you understand it and can demonstrate why it's a better control, why it's a more safe and sound approach to the program and whatever program you're deploying the control in. Next slide, I think, is back to Mark.
Yeah, I just want to follow up on that point, Craig. I mean, I spend a little more time on the safety and soundness side than you guys do, and just so often I would hear, easily 10 years ago that you would ask about, a new, not even a product, but a new internal, service that the bank had, and the response was, oh, well, it's a module from fill in the blank Jack Henry Fiserv, and that was sort of the explanation of it's okay for us to use, and we just use it. And I think over the last decade you've seen, or decade plus, more focus from the regulators on a policy standpoint of control over third-party vendors and really forcing the fact, but that the institution has to have some greater relationship with the vendor other than, well, we trust them, it's good. But really more at the ground level, just as you point out, it's how are they using these new products and services from whether it's a third-party core processor or other provider, that it's not just based on a sales pitch, but that the institution truly appreciates how the product is working and how it's providing control within the within the institution. Brad, you can hit the next slide. Topic that kind of goes along with things moving away from a physical branch at some level, is CRA reform, and as we all know, CRA has been around for 40 plus years, dating back to 1977, and the quote back then was serious reservations as to whether any regulatory agency could have the wisdom necessary to administer such a system to the maximum benefit of competing economic interest. And, one might argue that over the past 40 years that quote is, probably come pretty close to hitting it on the head. What's been interesting to me is there's been such slow progress as banking has evolved over 40 years, or even over the last 10, till just recently. And obviously, unfortunately, there's no, and you can hit the next slide, there's no unified reform yet where you have the OCC and the FDIC were working together, issued a joint notice proposed rulemaking back last December to greatly modernize CRA and to really try to refocus, not maybe the mission or objective of the Community Reinvestment Act, but certainly the way it's being implemented to hopefully drive more, lending and economic development to the communities that really need it, but also modernize how, the institutions are being measured and being tested for their CRA compliance. Unfortunately, the Federal Reserve is, still somewhat on the sidelines here, but that was put out in December. And then, Brad, you'll hit the next slide. Back, I guess, three weeks ago or so, on May 20, the OCC issued its final rule, and the FDIC said, "Hey, we're not quite there yet." And many in the industry say it was Otting's sort of parting gift as he stepped down as OCC comptroller. But what it does, it does based on comments codify the notice proposed rulemaking. And what the again general point is to modernize how CRA is being measured. So it's clarifying what types of activities now will qualify for CRA consideration, really expanding how banks can get that credit. I think really central to this discussion is how the assessment area is being defined. Assessment areas were traditionally defined by, where is your main office, where are your branches, what are the census tracts served by those physical locations, and then you were measuring the, lending in those specific tracks to determine whether the bank was complying with CRA. Now, what the final rule from the OCC and the joint proposed rule from the FDIC and OCC essentially say is, hey, if you're under a certain threshold, we can keep doing things the way we're doing. So, if you're a small, true community bank and your business is still driven by geographic location and people coming into the branch and you just want to be measured as you always have been, that's okay. For folks that are more in the digital space, so to speak, that are gathering deposits from different locations, aside from their physical footprint, the banks are given the opportunity now to further define what their assessment area should be. Where are they getting the majority of the deposits from? And then that will become their assessment area where their lending and other CRA activity will be measured, which is just, a really, really significant change, I think. And I think, frankly, for a higher level view of it, it really should, more accurately define and really meet the objectives of CRA, where, if you're a bank that's located in, X city, but you're getting your deposits from Y city, then, that's where you're going to be measured. And I think it is actually fairly innovative. And, again, as someone who's been doing this for a long time, some of the innovation I am seeing from, the federal agencies has been fairly impressive. And the new comptroller has come in his opening statement. He basically said, "Hey, I'm an innovation guy, and I'm looking to create ways to be more innovative of how we're going to, review our banks and examine them." And I think the CRA reform is right in that wheelhouse, and also how to promote other expanding technologies. So I think again you're seeing a shift, and maybe I'm a cynic, but somewhat surprising to me. The federal agencies are being somewhat proactive to shift the regulations a little bit to address how things are changing in the marketplace.
Yeah, I agree, Mark. The one thing I would add is like when we're dealing with some banks as clients, you can see, if you're speaking to their CRA officer or, they're in the middle of some M&A activity and they're working on their future CRA strategic plan, you can really, those that are afraid of these changes that are coming in the CRA or, feel challenged by them because, they believe that their program was working are generally those that weren't trying to innovate in their product suites or innovate with their tech partners, just because those that were frustrated with the way that they were reporting their CRA credit or that they could, what they could conceivably pull into their CRA program. These changes make that a lot easier. It should really work well when you're working on a strategic plan for an M&A application, or if you're looking to move from a satisfactory to an outstanding. If you're working with an account aggregator or online originations, your footprint really needs to change in order to drive those ratings.
Yeah, no, I think that's absolutely correct, Craig. I mean, I'll also say I think a lot of individuals in those roles, I think for fair reason are suspect. Okay, you're changing how we're going to be evaluated, and even though it sounds good on paper, I want to see what happens at my next CRA exam. I think that's a fair concern.
Yep.
So what we'll do now is we'll shift and we're going to start with the baby steps and work our way up to more elaborate methods of incorporating technology into banking. So one of the things that we've seen a lot of focus on in the last 4 years is alternative underwriting data. And what this means is anytime you're going out of your traditional loan application, pulling a credit report and taking that data, putting it with the information you've collected from the applicant, such as his or her income, name, address, bio data, what we've seen is there's been a big push to try to understand alternative underwriting. And so we have some massive companies, largely driven in the FinTech sector, that's looking at information like educational attainment, job and income data. Some of the more creative things we've seen recently are things such as rent payment history, telecom payment history, things that are trying to pick up individuals that may not have what we consider traditional credit reporting agency or consumer reporting agency data files, looking at things that may also show ongoing obligations to pay, a sense of payment history, as well as income. So, really creative things that are starting to come online that are now being brought out and brought into the mainstream banking space. As we think about this, we saw even as early as 2015 in some of these Forbes articles that we cited, when you look at folks, particularly millennials, they're not using traditional forms of credit that typically are reported to consumer reporting agencies, CRAs. Instead, more and more focus is being placed on those individuals' cash flows, how they're dealing with their debts, their ability to service the debt, what other obligations they show. And the really interesting thing is a lot of times, and there's empirical evidence to back this up, Craig will talk about a little bit more in regards to one of the no action letters that CFPB issued. That data is actually more predictive than traditional credit scoring. One of the things we saw around the same time that this began to first take off, CFPB issued a report looking at the unbanked and underbanked. And so what they found, and this is particularly important in terms of if you're looking at expanding market share, 1 out of 10 adults has no credit history file with a consumer reporting agency, 26 million Americans. Add on top of that another 8.3% of Americans, so a total of 18% of the U.S. population cannot be scored simply by obtaining a credit report from one of the mainstream consumer reporting agencies. If you want to target that group with financial services, which is a great thing to do with responsible products, then in those groups, you're going to have to find something other than traditionally go to a consumer reporting agency, input their social security number, pull that man or woman's FICO score, and use that as part of your underwriting decision. One of the most interesting things the CFPB notes is that as you look at the people who are within these two groups, credit invisible, or people who are credit opaque, meaning unscored or they have stale credit histories, it tends to skew against traditionally underserved communities. Particularly African American consumers, Latino consumers, and people in LMI census districts, low to moderate income census districts. And so there's this huge group of underserved people that you can then offer responsible financial products to if you're able to effectively underwrite them, because they're not going to show up, this 18.3% of the population, on a mainstream credit report.
Brad,
go ahead.
Just if I could add one thing there, I think it's important too, like if you're thinking about going into this space with alternative data, I know it's talked about a lot within the lines of business as, how do we increase originations? How do we, gain market share? When you're talking to the regulators, Brad's point is great. That should drive your narrative in the regulatory and compliance space, where you're not focused on growing your market share or growing your originations and assets. You're focused on helping the communities, helping the unbanked, helping the opaque bank, especially given that we're coming out of a pandemic. A lot of the traditional credit models are going to be difficult approvals in the coming 6, 12, 18 months. If you start to shift towards alternative data, and we'll see this a little bit as Brad said in the no action letter, you'll start to help those that were hurt the hardest in the pandemic. And that's a very good story, a very good narrative for your regulator if you start to approach them that way now with this, if you're looking to dip your toe into these waters.
And then we see in what's referenced here, the interagency statement, and it was all the main banking regulators as well as the Bureau coming together and saying, we support the development of alternative data for underwriting decisions. One thing we would caution you with is, just like any other factor that you use in making credit decisions, it's going to be subject to FCRA, ECOA, and various other federal regimes. And so one of the things that is continuously emphasized, if you want to dip your toe into this, is remember any sort of factor that you use, and we'll look at an example later with Craig that focused on educational attainment and current job placement and situation and continuity of the current job. When you look at that type of data, be aware that that data is still subject to ECOA and FCRA restrictions, meaning you need to understand what that data is doing in terms of your approval decisions, your pricing decisions. Is it disparately impacting individuals in protected classes? Is it increasing access to credit, which has really been the purpose of a lot of this alternative data underwriting, or is it seeking to further limit access to credit? One of the neatest things, and it's specifically endorsed in this interagency statement, is what we call second look modeling. When we talk about the Upstart no action letter, what Upstart was doing and what many others in the space have done is said, okay, we're going to take, Bill or Sue, and we're going to run them through our traditional underwriting model, and we're going to determine if we can offer credit to Bill or Sue based on that. But if they fall out, we're then going to look in alternative underwriting and see if we can pull them back into acceptance through the second look program. And one of the things that the interagency statement focuses on is that's really that tool that Craig was just referencing that reaches out and allows you to bring in additional people, bring additional consumers to the table, make credit available to them who may have not worked within traditional credit score-based underwriting models. And obviously, as always, all of that is subject to a robust compliance management system. But when you do it right, what the no action letters show, what the data sets show, is this can be a very powerful tool for expanding the reach of your financial products. Fair lending risks, obviously top of mind anytime we talk about alternative credit underwriting models. Understand that there are some significant corollaries between individuals in protected classes and some of the credit outcomes. And anytime you're doing that, we've had some of our clients get down to where they're looking at over 2,000 potential different underwriting factors and trying to build models out of that. Anytime you go that far down the rabbit hole, as they say, understand that you need a very robust compliance management system because of the potential for disparate impact. One of the largest challenges historically that creates disparate impact is credit scores itself. Understand how that test works. Understand the obligation to show a rational basis for the decision and that there was no less discriminatory underwriting criteria. Understand how those ECOA obligations work, and then make sure you're working with a good law firm or good consultant who's helping you validate your underwriting models and checking for potential disparate impacts so that you don't run afoul of these traditional consumer protection laws. Because anytime you start to build alternative underwriting, you potentially are then tripping over either, and probably top of mind, FCRA, which governs the use of consumer data from third-party sources, the Fair Credit Reporting Act, and the Equal Credit Opportunity Act, ECOA, because of the potential to disparately impact individuals in protected classes. One of the things that we see as we look at alternative data, and there's a series of cases that are out there, is, different people have experimented with different types of alternative data. And so, one of the most recent was the Sallie Mae cases, where Sallie Mae was taking into account the school you attended. And what the Sallie Mae was looking at what's called cohort default rates, meaning they were going in and saying, okay, people from your school tend to default at this percentage, and therefore we're going to underwrite you and assume you will default in a similar percentage. This picked up HBCUs as part of that cohort default rate scoring, and ultimately led to a series of class action lawsuits against Sallie Mae that were ultimately settled. Sallie Mae did away with the underwriting, entered into remediation plans, and ultimately did a lot of outreach to HBCUs and the graduates or students who are in those programs. But it can be, really extreme. I mean, we put the Facebook cases up here. There was a study done where if you were a financial institution, these were options that Facebook would make available to you. You could target your marketing to women in the workforce, quote, foreigners, quote, Puerto Rican islanders, or people who viewed things on hijab fashion or Hispanic culture. Most of us sitting here, with a compliance background or in financial institutions are like, my gosh, you'd never, ever target these particular groups on these bases. But that's what the technology makes available, and those are actually options for you to select if you are a financial institution. So make sure that as you are experimenting with alternative data, you're thinking about the effects of it that it may have on individuals in protected classes. And something as simple as, for instance, high mileage vehicles. Zest Finance came out with a big study that said they had done analyses of that. And if you begin pricing your indirect auto portfolio on the basis of the mileage of the vehicles, there is a disparate impact on African Americans, given the buying patterns of that community. We've got here just kind of an overview. You can think about kind of what I would call non-traditional credit at one end of the spectrum, where you're looking at other financial products that may just not have traditionally been picked up in consumer reports, but it's going to continue all the way up the spectrum. And as you go up and the more out of the box you get, in essence, the higher those fair lending risks and compliance risks are. So as you scale up that ladder, just make sure you're thinking about what impact that may have from a compliance standpoint. Shifting from some of what we're seeing in the marketplace, we're going to talk about what is perhaps the hottest issue at the moment, which is what are called bank FinTech partnerships. Really an innovative way to bring financial services to consumers. And what we see is that there was a flip. If we look at the 90s, 80s, into the early 2000s, financial technology were companies that were building things for banks, building things for lenders. They were the back end, and the bank or the lender was the front end. What we saw in the late 2000s, early 2010s is a flip. FinTechs are now, to hit on what Mark mentioned earlier, they're the ones running the Super Bowl ads. They're the ones bombarding your Google searches. They're the ones on Facebook and Instagram and TikTok and all the various social media platforms, not the banks. And so you saw a flip where the banks and credit unions and lenders are becoming the back end of the technology, and the FinTechs are becoming the front side. And then we get, obviously, Comptroller Otting, as he took the helm of the OCC with this quote that I think is just really telling, which is, first, FinTechs thought they wanted to be banks. And now they realize that being a bank is complicated, and you have to provide all of this capital, liquidity, commitments to communities that they really don't want to be. FinTechs focus on dynamic, focused use cases. And so now they're moving to banking partnerships. And many people ask me, why is that? Well, as a FinTech, there's only one way to control your costs, really. And that is either you cut down on how your cost of acquisition of a customer, or you cut down on your infrastructure costs. And if you think about somebody who is, for instance, a state money transmitter, somebody like a Western Union, a MoneyGram, people who have the infrastructure traditionally to go across states, they're not banks, but they're handling the movement of funds. Well, if you were to try to go out and get 49 state licenses right now, plus the infrastructure, plus the bonds, you're looking at probably 2 years, a couple $1 million in regulatory and legal fees, plus on top of that, an infrastructure to deal with 49 state regulators, all regulating the transmission of funds. Same thing with lenders. If you're going to try to run a nationwide lending platform without being a bank or a credit union, a chartered financial institution, you're going to need dozens of individuals in your compliance department simply to respond to the examinations in all of those states that you're carrying licenses in. Banks avoid that. Credit unions avoid that. They're able to go state to state, offer nationwide financial services without having to get licenses at each level. 2019 survey we have referenced here from Cornerstone, really interesting, the number of banks and credit unions that say how important are FinTech partnerships and collaborations. And so if you look at the somewhat important to very important, striking numbers. Half of banks, more than half of credit unions say FinTech partnerships are going to be how they think about growth going into the 2019-2020 cycle. And I would say that this is pre-COVID. Post-COVID, I bet these numbers are dramatically higher because now all of those banks and credit unions are seeing the importance of those partnerships to offer financial services in a non-face-to-face environment. When we talk about the mutual benefits, it's really an interesting kind of use case here because they're two very different cultures. FinTechs are innovative, nimble, they're a culture of creativity. Financial institutions are solid, compliant, controlled, they plan ahead and they don't get outside their lane. But you can bring them together and really get some innovative solutions. The FinTechs gain from having this control, the regulatory oversight, the certainty associated with banking and finance. And then the financial institution gets that innovation, that ability to scale. So it really can be a nice kind of complement between the two. And as we think about FinTech opportunities, think broadly. I mean, these are just kind of a sampling of some of our clients in the space. But it's not just simply we're going to partner with a lender online or we're going to offer a mobile wallet. Financial institutions, banks, and credit unions are doing crypto. They're doing AR processing and bill payments. They're doing obviously lending models, online accounts, non-bank banking products, investment advisory, broker-dealer integration. Some of the neatest things we're seeing now are what we call wraparound banking, where one platform is going to let you have your investment advisor, your brokerage account, your banking products, plus high-yield savings, plus free checking or free transactional accounts, plus mobile payments, all wrapped into one unified interface, as opposed to going to 4 different providers for those 4 services. And really the secret to that is going to be having those regulated financial institutions sitting in the background so that they are able to see, and have that ability to go state to state and really scale these types of programs. Here we really talk about the scope of FinTech models. At the very top we have perhaps the most basic, which is either the bank sends people to the FinTech. We saw that, for instance, Cabbage had a big program with the Paycheck Protection Program. If your bank didn't want to engage in PPP lending, you could enter an agreement with Cabbage, and Cabbage would try to underwrite some of your customers who couldn't come to your bank to obtain a PPP loan. And so the bank would refer it over to the FinTech. Similarly, the FinTech may be driving referrals to the bank. We see right now the growth significantly in what are called deposit networks, where different FinTechs are partnering with these deposit brokers. They come around to your institution and start sending you deposits. Same thing on the lending side. People go and they go to someplace like LendingTree and they say, show me offers for a small dollar loan of X amount and tell me what's available and what the APRs are. And then LendingTree can send them to your financial institution. Baseline, fairly kind of easy way to dip your toe into FinTech. But then you see that next level, which is really building, with the FinTech, either investing in it. Recently, we've seen a number of banks acquiring FinTech companies and then selling it to other financial institutions, or you're doing what's called private label solutions, which is, what we so many are used to with our core providers, which is you go out to a financial technology company and you say, I'd like to have the following products. I'd like to have mobile RDC. I'd like to have peer-to-peer payments. I'd like to have the ability to offer bill pay. They turn it on inside of your financial institution, off you go. More and more, we're seeing banks partnering with each other. Maybe you're a smaller bank and you need to work with a larger one to get additional products, or you're a smaller bank with niche areas, such as maybe you're a very good SBA lender and you partner with another financial institution and you have that referral relationship. Sometimes we see what's called partial outsourcing, where we're going to take a portion of the bank's operations, maybe it's that alternative underwriting, and we're going to work with a FinTech vendor to offer that product to our members or our customers. And then at the end, we talk about what we call true bank model partnerships. This is perhaps the most cutting edge that we're seeing right now. A lot of our clients are playing in this. Some of the fastest growing banks in America are doing this. And what this is the bank comes in and says, I will be the entity that is moving payments, holding funds, or making loans, but I'm going to partner with a FinTech so that they're the marketing arm, they're the face. And so if you look at case studies like Cross River Bank, great example of New Jersey bank, state bank, that partnered with a lot of FinTechs, huge growth. They're now the back end of some of the largest lending players in the lending FinTech space online. WebBank did a lot of it. You see some really innovative banks who are going out, getting into this space, experiencing huge growth as they build these bank model partnerships that are really acting to transform the bank. And so now I'll turn it back over and we'll talk a little bit about moving to digital and how you think about that.
Thanks, Brad. So if you're looking to start to move your originations or your businesses into an online platform or a digital space, or looking to build it out more with greater speed, like Brad's talking about with the FinTech partnerships, you're going to want to look to where you can go for guidance. So first place would be the OCC Office of Innovation. To Mark's point earlier, he was talking about how proactive the regulators have become in this space. The OCC started back in January 2007 with creating an actual Office of Innovation. They have their stated goal up here on the slide, but it's a good resource with FAQs and touch base for what they're looking for, what they deem as the risk, and how to move forward responsibly. Another great resource that we like to recommend here is the FFIEC e-banking booklet. Just like with any compliance program or regulatory program, we recommend that you look at it backwards, look what the EICs are going to be looking at, how you're going to be regulated, how your exams are going to occur when you actually go into these activities, and just work backwards, build it out from there. Look what they're looking at and kind of respond in kind while building your program. This e-banking booklet touches upon things like managing outsourcing relationships, the due diligence for FinTech outsourcing solutions, what you should be putting in your contracts with third-party services, or at least what the EICs are going to be looking for within those contracts, what a proper oversight and monitoring and testing program looks like for TPOs or third parties when you partner with FinTechs. And also another great resource here is Appendix C of this booklet. There they have a lot of the regulations that you're going to have to start to contemplate and maybe build out within your policies and procedures, such as the GLBA, your SAR reporting, Patriot Act implications, e-sign, how you're going to conform to that, or any of the state UITA regulations. They also reference a bunch of applicable guidance from the FDIC, the FRB, the NCAU, and the OCC. All of it's on point if you're looking to get into these spaces. All of it's very, very valuable if you're either currently partaking in these opportunities, or if you're about to. You should really go through these two resources and see what's out there and make sure you're as compliant as possible. Next slide, Brad. So the CFPB is the second regulator I want to talk about here. Their sandbox was created over the last 2 years. It's fairly intricate, and one thing I do like about the CFPB is how much they document, how open they are with their. Let me rephrase that. Not how open they are within like exams or investigations, but how open they are when they're just talking about the regulations either that are going to be rolled out, that are currently out there, or with their guidance. And they did the same with the sandbox here. They state there are 3 goals at the top there, but there are multiple programs that we outline at the bottom. There's multiple sandboxes. There's a compliance assistance sandbox. Here, companies can obtain a safe harbor for testing any innovative products or controls or services for a short period of time, but you have to share all data with the Bureau. That's a double-edged sword. It could either work great or be a kill shot to whatever you're trying to do. We also have a trial disclosure sandbox. If you think you've built a better mousetrap for any of the disclosures that are required in any of the consumer lending products that the CFPB governs, you can partner with them here to roll that out. Again, have to share all data with the Bureau, so they will be looking at it with a critical eye to see if it's actually improving the consumer risk that's out there, or what they're actually looking for is a minimization of that risk. They also have a pitch a pilot program, which is interesting. If you have an idea as a FinTech or a bank, you can go to the CFPB Office of Innovation and pitch it right to them, see what their original thoughts are, or see if they think it would be a good fit for any of the sandboxes or an NAL. And with the no action letters, next slide, Brad. So no action letters are a portion of what those sandboxes, an opportunity within those sandboxes. You can apply for a no action letter from the CFPB. A good example of this is Upstart. In September 2017, the CFPB issued a no action letter for Upstart. They were one of the pioneers in alternative data, how they were underwriting loans that Brad was talking about earlier, and his uses of alternative data. They were encouraging friendly developments at the time, and they want to see innovation here. So they like companies like Upstart, but like I mentioned earlier, they're going to have to share the data with the CFPB. So for Upstart, it was, again, that double-edged sword. It could have either killed the idea, killed the startup, or propelled it. And in this case, it worked out for Upstart. If you go to the next page, Brad, you can see some of the data that was returned by the CFPB. In August of 2019, the CFPB released the data that they were seeing from their work with Upstart. And they noticed that it was increasing credit to a bunch of protected classes, and it was opening up those that had challenges under the traditional credit model. And you can really read into this data and see the CFPB is supportive of efforts like this. And if you were to go into the use of alternative data, there are documents out there, guidance out there from the Bureau that supports a narrative of why you'd want to enter these spaces. Next slide, Brian. We also have FinTech sandboxes in various states. I picked 3 of them here: Utah, Arizona, Wyoming, for 3 of the most active, or at least the most built out. Utah currently has no one participating, but it's good to note that it's not just financial services. They're actually looking for security insurance product providers as well. Arizona has a fairly robust sandbox and has a lot of participation. They have some of the companies that are in there are income share funding companies that are looking at consumer loans based on income share agreements, blockchain companies, people that are looking to deliver more simple transactional services to unbanked population of people out there, companies that are purely based on that. Zona Digital is in there. It's a financial services club using money transmission services in connection with the sale of digital assets, aimed at providing cash management solutions for licensed medical marijuana providers. There's a lot of different spaces being explored in Arizona, and it's a very good program if you're looking to dip your toe into what Arizona's a great state to start. And I also list Wyoming in there as well. Again, they have it signed into law. Their sandbox is currently very active. If you want to check those out, those are hyperlinks all to the pages when you receive a deck, if you want to look to see what they're doing or look at any of the FAQs of what the state's looking to do from a regulatory perspective. Next slide, Brad. And we do want to finish up and leave somewhat little time for questions if there are any, but we wanted to show you, Brad did mention earlier that the FinTechs aren't looking in general to become banks, but looking to partner with banks, but there are some out there that are looking to, grow faster, that are more aggressive in the space. And these are some of the options that they have. The OCC FinTech Charter was the first thing that we saw back in December of 2016. It was structured as a solution that would allow non-depository FinTech companies to operate under a federal charter, thereby relieving them of the obligations of state-by-state regulation. Same thing, it's the same driver that we see moving these FinTechs to bank partnerships. This was just a charter solution, so to eliminate the need for a partnership. But as expected, we didn't really see much interest from the FinTechs. First of all, it was very expensive to obtain the charter. And then second, it was met by significant resistance from the various state regulators who viewed this as losing a large portion of their control within the financial spaces within their states. So we did see New York DFS, the Department of Financial Services, lead the charge of litigating against the OCC over this through late v. the OCC. The case is currently on appeal, so all activity in the OCC FinTech Charter is on pause, but we're all watching to see how that appeal progresses and what comes out of that. Second, I want to bring up the Lending Club Radius acquisition. So Lending Club was a San Francisco-based online lender that said that they were looking to obtain a national bank charter, and they did so recently when they acquired Boston-based Radius, who had about a $1.5 billion, $1.4 billion in assets, and they were offering checking and savings accounts as a traditional depository. That was the first time we've seen a FinTech or a non-depository acquire a bank and get their charter. And Lending Club stated that it's the perfect fit, that they're looking to grow their revenue sources or their streams of revenue, as well as implement a stronger regulatory and compliance scheme under a national charter. We also saw Square. This is the alternative pathway possibly offered by the FDIC. In March of this year, Square became the first U.S. FinTech to receive conditional approval from the FDIC for an industrial loan charter. And they paired that with an existing charter that they had under the Utah Department of Financial Institutions. So we do see them taking that avenue. So you're starting to see, while FinTech bank partnerships are growing, and that's where we're starting to see the most innovative partnerships and high-speed growth in the space, we are seeing FinTechs explore other avenues as well, such as these three. And it further drives home the point that you may not need to, flip the switch to an all-digital solutions, all-digital origination channels, but you're going to have to start to evolve that way. And I think the point that we're trying to have everyone move away from this webinar with is that the pandemic just sped this up. You're seeing banks recognize the need for online solutions, recognize the need for online controls, and the FinTechs are going to come out of this pandemic and try to leverage it the best they can, grow as quick as they can, and become more of a necessity for the banks. So we believe that you should move sooner than later, but also know that you should move in a controlled pace, contemplating your regulatory and compliance controls with any partnership that you decide to do, or any move into these spaces that you decide to do. Do it in a controlled manner in partnership with your regulators to do it responsibly. I think with that we can move to any questions, Brad. Yes, that's the end.
Yeah, absolutely. And so if you have any questions, there's a question link there. You can send those in, and Clara, who is our coordinator, will let us know, and we'll be happy to answer those. Mark, let me turn to you. Any final thoughts? And I guess I'll go first. One of the things that we focus on is understand that there's this continuum when we talk about bank FinTech partnerships, and it can be something as simple as, like we say, referral relationships, going all the way up to the point where you're seeing the blending of the roles of the FinTech and the bank. All present really unique opportunities for chartered financial institutions, whether you're a lender, a credit union, or a bank, to really expand not only your assets, but also your lending portfolio, and do it in a really responsible way. I mean, there's certainly ways to expand organically that's potentially more difficult in a post-COVID environment as we're starting to recover from a lot of the shutdowns that kept us from having face-to-face interactions with customers. And so working with these FinTechs gives you a lot of opportunities in the near term to potentially, in the right way, drive that type of growth. part of the most important issues there is making sure that growth is right. There's plenty of fintechs who are offering products right now looking for banks or credit unions or licensed lenders who are all out there saying, okay, tell me what it is that you want. We'll go out, we'll run it onto the internet. Make sure you're thinking about it in a compliant fashion. Make sure you're running it through your compliance controls. Mark or Craig, any final thoughts, or Clara, any questions we've had sent in?
Well, Brad, I would just jump in. I think really your point is well taken, and I think part of a bank can start using a fintech partnership to. I think, as Craig said, it's not a flipping the switch. It's deciding, what channel is appropriate for you. If you can't develop on your own, you can find the right partner to sort of dip your toe in. And then the two other points is you have to build the back office to make sure it is compliant and to do that on the front end. And I think the advice of running it by your examiner and in charge or other regulator, just so it's not a surprise to them at your next exam, is always a good idea.
All right. Well, thank you everyone for joining us today. We appreciate you participating in our ongoing In the Trenches series. We realize that in this particularly challenging time, it's all of you who are out working with customers, keeping the financial services flowing within our country. That's so important. And so we appreciate what each of you are doing right now. If you have any questions, follow-ups, want to discuss any of these, or even go down the rabbit hole of bank model partnerships, be happy to chat with you anytime. Feel free to reach out to any of the attorneys at Nelson Mullins in our financial services practice. We'd love to explore that with you. In the meantime, stay tuned. We'll have our next installment next week of In the Trenches. We're going to be planning to do it on consumer compliance issues, but stay tuned. We're waiting to see if the Paycheck Protection Program revised forgiveness guidance comes out this afternoon or tomorrow morning, which may change our schedule somewhat. In the meantime, thanks so much for joining us. We look forward to talking with you next week.